Imagine earning money while you sleep. Intriguing. Let me show you how property investing can make that dream a reality. Picture owning a house that pays you every month. You are on vacation and your bank account grows. It's not magic, it's property investing. Investing in property might sound complicated, but it doesn't have to be. The overloaded information might make you feel overwhelmed by the idea of investing. Think about property investing like a strong ship in a stormy sea. It holds its value even when things get rough. In this video, I will break down the factors, benefits, the downside to consider, even the cost involved. However, watch this video to the end because I will tell you what the strategy to get started are called and how it works. Welcome to TAP, the Art of Prospering, where are your simple drawings to break down the world of finance and give you a financial foundation and the knowledge using everyday scenario so you can go and make better decisions about your money and your investment. So, what is property investing? Property investing means buying property to make money, not to live in yourself. Instead of using the property as your own, you rent it out to other people. When you rent out a property, the tenant pays you money for the rent each month. This rent money will help cover the cost of owning the property, like your mortgage, which is the biggest loan for buying a property. By charging a little bit more on the rent than what it costs you to own the house, you can make profit. Sometimes property value go up, so when you decide to sell later on, you can make more money than what you originally bought it for. Property investing takes planning and managing your money wisely to ensure it's a good investment and that it will pay off in a long term. So let me tell you some of the ways at which you can invest in property, but I will break down the three main parts. First, we have residential properties. This means buying houses or apartments and renting them out to people who need a place to live. Residential properties are a good starting point for beginners. Commercial properties. When you own a commercial property, you rent it out to businesses instead of people. Renting to businesses can sometimes make more money than renting to people because businesses often pay higher rent. These are buildings used for offices where people work, shops where people buy things, or warehouses where goods are stored. Then we have real estate investment trust, also called REITs. REITs are like companies that own and manage many different properties. When you invest in a REITs, you are buying shares, which is like a small pie of the company's portfolio. REITs can own all kinds of properties from apartments to buildings to shopping malls to offices. Investing in REITs allows you to make money from property without needing to buy the property yourself. Now let me tell you why investing in property is important. First, we have capital appreciation. This growth, known as capital appreciation, helps build wealth without much effort. Investing in popular locations with strong demand for housing or business spaces can lead to a significant financial gain as property value rises. Leverage. This means borrowing more money to buy a property and using a little bit of your own money. This could be as little as 5% of the property value, and a bank or a lender will give you the rest of the money to purchase the property without having to bring in all of your own funds. Now, let's talk about strong and stable return. Homes and buildings like offices make money from rents and might become more valuable over time. By setting the right rents and managing your expenses wisely, you can increase your profits significantly. Now, let's talk about passive income, or we can call it a regular income. This reliable income stream is one of the main reasons people choose property investing. When tenants pay their rent each month, it gives that regular income. This regular income is useful for those looking to add to their main income or build a long-term investment portfolio. Let's talk about the edge against inflation. When inflation occurs, property value and rental income tend to increase as well. This means that the money earned from renting out a property and the property overall value can both increase. By owning properties, you can potentially offset the effect of inflation and maintain the purchasing power of your income and your investment. Diversification. When you spread your money across different types of investments like stocks, bonds, and property, it helps lower the risk. If one investment doesn't do well, the others can help balance things out. So when the market feels uncertain, having property can help you feel more secure. You know all your eggs are not in one basket. Investing in property can be incredibly rewarding, but it's important to do your homework so you can make informed decisions. So let me give you some factors you should consider before investing in property. Location, location, location. The location of your property can greatly affect its value and potential for making money. Properties in desirable areas like schools, parks, cities, and good transport link attract tenants and buyers. This can lead to higher rental income and increase in property value. On the other hand, properties in less desirable areas might not attract many tenants and buyers, impacting your potential income and growth. Let's talk about market analysis and rental demand. It's crucial to assess how well an area is doing economically and its potential for growth. Factors like jobs, population growth, amenities does affect your property value and demand. Understand the rental demand is key too. Check vacancy rates, check the rental prices, the demand for different property types in your area. This will help you make a smart decision about your investment. Now, property types. You can choose between going into residential properties or you can choose into going to commercial property space. Residential properties provide steady income from tenants, which is often stable, while commercial properties like offices and store do yield a higher return, but this income is tied to the success of the business. Now, let's talk about your financial options. The question is, how will you pay for it? Most people use leverage, which you pay back over time with interest. Now, how do you access this? You need to have a good credit score, which will show how reliable you are at repaying loans. This will affect your ability to get a mortgage and the interest you might receive. It is wise to consult a financial advisor or a mortgage broker to choose the best mortgage option for your investment plans. Let's look at the costs you should consider when buying a property. Firstly, we have stamp duty. When you buy a property, you might need to pay a tax to the government. This tax is called stamp duty. It is a one-off fee based on the price of the property. Next, we have deposit. When you want to buy a property, you need to put down some money up front to show you are serious about buying it. This upfront payment is called a deposit. Legal fees. These are costs you pay a lawyer or a solicitor to handle the legal work involved in buying a property. They make sure everything is legal and correct. A valuation fee. Before you get a mortgage, basically a loan to buy this property, a bank or a lender wants to know how much this property is worth. They hire someone to assess or value this property, and you have to pay for this service. Estate agent fees. When you sell a property, you might need to hire an estate agent to help you market it to find a buyer. The estate agent charges a fee for this service. Refurbishment. Sometimes a property needs fixing up or renovating before it's ready to be lived in or sold. This process of repairing and improving this property is called refurbishment. Mortgage fees. When you get a mortgage or a loan to buy a property, there is a cost such as arrangement fees, application fees, and broker's fee, which the lender charges. You might have to pay for this. Surveyor's fee. A surveyor is someone who checks the property and reports its condition. You have to pay for this service. Understanding these terms will help you know what costs are involved when buying or selling a property. Property investing has its perks, but also its downside. So let me tell you the downside of property investing. Firstly, we have property value. When the economy is bad, fewer people can afford to buy or rent home. This lowers demand and causes property value to drop, which leads to fewer buyers and lower property prices, making property investing less profitable. Interest rates. Inflation and economic downturn might cause higher interest rates, making mortgages more expensive. So homes become less affordable and property value might drop. Maintenance costs. Properties need regular maintenance to keep up with the value and to keep your tenants happy. However, this can cost a lot over a long period of time because the wear and tear, which can become quite expensive. Ignoring this maintenance can cause bigger problems over time. Liquidity issues. Buying and selling of a property can take a long time. While waiting, owners still have to pay for their mortgages, the maintenance, and insurance, especially if your investment property is empty. These long waits can lower your profits if the market gets worse and costs go up. Tenant issue is a financial risk of owning property. If a tenant doesn't pay their rent, it can cause money issues, especially if you need that rent to pay the mortgage. Tenants might also damage the property, leading to expensive repair and an empty property. Trying to evict tenants is a long and costly process, so consider what kind of tenant you need to put in place before going into property investing. Finally, we have economic downturn. Recession often leads to a decline in property value due to reduced demand, making it difficult to sell without losses. The economy plays a significant role in the property investment journey. Some of these downsides of property can be avoided, so let me give you some tips for a successful property investing journey. Conducting due diligence. When you're thinking about buying property, it is really important to do your homework. This means carefully looking at everything about the property to avoid problems and getting the most of your money. Check the property's condition, see if it needs any repairs, and review the cost. Also, look at the market trend to know if the prices are rising and if there is a rental demand in the area. This will help you make the smart choice and avoid unwanted risk. Let's talk about setting realistic investment goals. You need to think carefully about what you want to achieve with your money by making clear and reachable goals that matches your current financial situation. You can make better financial decisions. Having clear goals helps you stay focused and make it easier to handle the challenges that comes with property investing. Now let's talk about having the right network of professionals around you. Building a team of experts is important when investing in property. You will need to work with estate agents, other property professionals, builders, accountants, mortgage brokers, solicitors. These experts will help you make better decisions, avoid risks, and be successful in property investing. Finally, let's talk about how you can adjust your investment strategy to the economy. Regularly evaluating and adjusting your investment strategy is important in property investing because the property market changes often. By adjusting, it will help keep your approach aligned with the market trend and your financial goals. Being flexible and making adjustments when necessary will help maximize your investment return. At the beginning of this video, I told you I would tell you the strategy to help you get started in property. So here are the three you can use to get started in property investing. First, we've got the BRRR strategy. So the buy, refurbish, refinance or remortgage, rent and repeat strategy is a very well-known and popular strategy you can use to get started in property. This strategy involves you buying a rundown, out-of-date property, refurbishing or renovating this property, then you go to the bank to remortgage or refinance this property, then you rent it out to a tenant. After renting it out, you will pull out some money and you are able to repeat the process. The next known popular strategy, the flip or the buy and sell. This is buying a rundown, outdated, dirty property, renovating it, refurbishing or fixing it up, then selling it, making a profit from the sale. Finally, we have the buy to let strategy. The buy to let strategy is just a simple strategy that involves you buying a property and renting it out. Hence, we call it the buy to let strategy. So these are the three main ways at which you can get started in property. So do your research and understand more of how this property strategy can help you grow more. So remember, the key lessons about property investing are: property investing is good for cash flow and steady income. You need to do your due diligence before thinking about investing in property. You need to do a lot of homework. You will need to also check your financial health to see if you are able to get a finance to get a better interest rate. Remember, there is also a downside to property, so be willing to adjust your strategy. Go and seek advice from a professional, a mortgage broker, or a financial advisor to let you know your position and how you can get started in property. Finally, through property investing, you can create wealth for a long term and become financially